And welcome back. Today we're going to be talking about monetary policy on NyQuil. Last time we talked about what money was, the functions that money had to serve or perform in order to actually be able to be called money. And this time we're going to be talking about different components of the money supply itself. So we're going to get a little bit out of the theoretical realm and more into like the practical and applied side of things here. Now, there are various principal components of money. The first one that we're going to be discussing is the money base, referred to as M naught. Now, the money base is composed of total reserves plus currency. So if you ever go to a bank and you deposit money and you see the vault open up and you see all that cash inside the vault, those are reserves. And then currency, well, that's the carrying cash that you carry around in your pocket. Back when we used to do such things before everything became electronic. Note that the money base is not the same as the money supply. That's something I want to clear up right now in case there's any possible confusion. The money base and the money supply are not the same things. Now, elements of the money base can enter the money supply, and there is an element of the money base that is also a component of the money supply, but the two are not exactly the same. Now, when we talk about total reserves, we're going to let this capital TR here, total reserves, be the sum of required and excess reserves. And then we're going to have this deposit component D, which is the actual size of the money base. And what we've got here is this M naught equals this lowercase rr plus lowercase er plus lowercase c. These are essentially how the money base is being split up. So with these reserves, just a quick little discussion on the reserves. They have some of these reserves, the required reserves, have to be held on to by the bank in the event that somebody wants to come in and withdraw funds from their account, because you'd be in kind of a bad position if, say, you were a bank and somebody came in and they're like, I want to withdraw all the money from my account, and you don't actually have any cash in your vault. Like, you'd be kind of screwed. If you've ever seen that movie, It's a Wonderful Life, it's something kind of like that happens in there. But anyways, if we let the deposit component be this capital D, and we've got the lowercase r being the ratio of required reserves to deposits that banks have to hold. ER is the ratio of excess reserves to deposits that banks choose to hold. And C is the currency to deposits ratio. Essentially, when we divide this whole thing out by this capital D, we get these fractions of RR, ER, and C that add up to 1. So they're fractional pieces of how the money base is composed, and then D is just a scalar that's equal to the size of the money base. So for an example, if, say, the money base is equal to $100 million, and required reserves equals 0.15, excess reserves equals 0.10, and then the currency component is the remaining 0.75, then essentially that just tells us how much of the money base is required reserves, excess reserves, and currency. Now, if we look at a time series of the money base from 1990 up to 2020, we can see that it's actually, for the majority of the sample period, grown at a pretty nice, slow, steady pace. And then we can see there are these 4 distinct hump shapes following 2008. That was after the financial crisis of 2007 and 2008. There was some rather radical, unconventional monetary policy used by the Federal Reserve. There were 3 rounds used in response to the financial crisis. And then the last 4th hump that you see here is what the Federal Reserve did in response to the pandemic of 2020. If we were to break the components down, look at a graph of this, what we would see is we've got the money base, which is the total of the money base. We've got currency, and then we've got reserves. Now, currency and the money base were actually almost equal to each other, with reserves being really, really, really small up until 2008, when there was a major shift in policy regimes at the Federal Reserve. And then you can see that reserves began to tick up. And what's interesting is, if you look at the shape of reserves compared to the money base, they follow almost the exact same path. It's just one is scaled up a little bit more, and that's simply just by adding currency to reserves, you get the money base. So we've talked about the money base. Let's talk about the actual measures of the money supply. The first one is M1. And M1 makes up the measure of the money supply that's got currency, which is physical money, as well as checking accounts, demand deposits, and negotiable order of withdrawal accounts. Now, I got a little bit of math here. I wouldn't worry too much about it. Essentially, all that we did is we took the money base and we divided out that RR plus ER plus C, but we keep 1 plus C. So we're essentially dividing out the non-deposit component of the money base in order to get like a money multiplier to be able to derive what is the money supply. Because remember, currency is part of the money supply. So this broad monetary aggregate is expressed as a multiplier of 1 plus C divided by the non-deposit component of the money base. Excess reserves are determined by the Fed's policies on discount lending, and then currency is determined by the public, how much carrying cash you want to carry around. Now, we're going to go up to M2 now. This is a slightly broader measure of the money supply, and this is the measure of the money supply that is most commonly referred to. If anybody's ever like, oh, well, the money supply this, money supply that, they're usually talking about M2. Now, M2 is everything included in M1 plus most savings accounts. We've got money market accounts, retail money market mutual funds, and small denomination time deposits. So it's everything included in M1 plus some other stuff. Now, if we were to plot out M1 and M2, you can see that M2 is quite a bit larger than M1 because it's, well, a much broader measure of the money supply. Now, the third measure of the money supply we're going to talk about is M3, and it's the total of M1 plus M2 plus certificates of deposit, institutional money market mutual fund balances, deposits of Eurodollars, and repurchase agreements. Note that the broader the monetary aggregate, the less liquid it becomes. So the money base is an extremely liquid measure of, or an extremely liquid monetary aggregate. You go a little less liquid, you get M1. You go less liquid than that, you get M2. And then you go like way less liquid than that, you get M3. So the harder it is to turn into spending cash, right, the less liquid that monetary aggregate is going to be. So how does banking work in the U.S.? Well, the U.S. banking system operates under what's known as a fractional reserve banking system. It's a system in which banks will take deposits from the public, and they're required to hold a portion of their deposit liabilities in liquid assets, cash, as reserves. Oh, I'm going the wrong way here. And they're at liberty to lend the remaining portion of these deposits. So if you make a $100 deposit in the bank and there's a 10% reserve requirement, they have to hold on to $10, but they can do as they please with that other $90. So bank reserves are held as cash in the bank, and the Federal Reserve determines the minimum amount that banks have to hold in liquid assets. That's what's known as the reserve requirement. Now, because banks hold less in reserves than the amount of their deposit liabilities, and because deposit liabilities are considered to be money, because remember the components of M1, under fractional reserve banking, the money supply ends up being much larger than the money base. And the central bank regulates bank credit creation. They impose reserve requirements, capital adequacy ratios, etc. And they do all of this to make sure that banks remain solvent and have enough funds to meet demand for withdrawals. This can also be used to limit the process of money creation to essentially prevent runaway inflation, right? Because if you end up printing too many dollars and you've got too many dollars chasing too few goods, you end up generating inflation. So this whole process essentially allows for the central bank to influence the money supply in the United States economy. And they can do this without directly controlling it by diktat, which is kind of nice, actually. They can use what's known as open market operations to kind of nudge things in a certain direction. In the United States, the Federal Reserve pursues an interest rate target. It's the federal funds rate, which is the overnight lending rate between banks. We'll get into that a little bit later. And this essentially controls the bank issuance of credit and the rate of inflation. Because if you have influence over how much money can be created, then you have influence over the inflation rate. So let's talk about some pros and cons of fractional reserve banking in the United States. Some pros. Well, we get financial stability. That's pretty good, actually. It's a pretty big pro. We get financial stability because the monetary authority, which is a central bank, it's a centrally planning entity, they can influence the money supply and therefore interest rates and inflation to essentially promote macroeconomic stability. And they have been fairly good at that ever since the creation of the Federal Reserve in 1913. There have been a couple of hiccups, of course. Nobody's perfect, but overall, financial stability has been quite good under the Federal Reserve. It also allows for banks to provide easier credit, and it can allow for longer-term loans to be made by banks to borrowers. But there are some drawbacks to fractional reserve banking. Namely, if banks can't maintain enough reserves, they may not be able to cover all demands for withdrawals. That can actually be really bad, especially if everybody decides they want to go to the bank and withdraw their cash all at once. You can end up getting a bank run. Bank runs are really, really bad. Now, most modern banking systems have some kind of a framework set up to prevent bank runs, but they can always happen. So let's talk about how money actually gets created. This is the way that fractional reserve banking operates in terms of generating new money. And that sounds kind of strange, but hear me out on this. Let's say I buy a new car that costs $50,000. The Fed's currently got a 10% required reserve ratio. So when I hand over that $50,000 to the car dealership, what they do is they take that money and they go deposit it into their own bank. The bank that they deposited that into can lend out 90% of that $50,000 or $45,000. They've got to keep $5,000 as their required reserves. Now, as soon as they lend out that $45,000, $45,000 was just created. Why is that? Well, because in fractional reserve banking, the deposit is a form of money, but the cash that was deposited can be lent out, which is another form of money. Thus, we make even more money. So every single time money is deposited and then loaned back out, we're creating new money. Whoever the bank lent that money to is invariably going to end up depositing it somewhere, right? Because, if somebody wants to borrow $45,000, who knows? They're going to get maybe another car, a boat, something, right? That money's going to get deposited somewhere in a bank. So another bank gets a $45,000 deposit, and they can lend out $40,500, keeping $4,500 in the vault. $40,500 was now just created. That money that gets created is deposited by somebody else in another bank, and then another bank can lend out $36,450. Thus, they create $36,450. And this goes on and on and on. Mathematically speaking, this goes on forever. And actuality, it doesn't really go on forever. But mathematically, this is what is an infinite sum. We get the change in the money supply, this delta MS equals MM times this delta D. MM is the money multiplier. Delta D is the change in the deposit. And that delta MS is the change in the money supply. Now, if we let R be the amount that we can lend out, the share, right, the fraction that we can lend out, and D be the initial deposit in the bank, it ends up looking something like this. And I would imagine this ends up looking like something that makes you go like, why in the hell did I decide to take this class? I didn't think there was going to be any weird calculus in here, but don't worry. We are not going to be doing too much calculus because this is a geometric series that has a value it converges to, so you don't actually have to do any calculus. It's actually quite nice. This geometric series converges to 1 over 1 minus r, where r is the fraction of the deposit that can be lent out. Now, if we were to expand out this sum, right, because we get the sum of, from I goes to 0 to infinity, of r to the power of I, we would get r to the power of 0 plus r to the first power plus r to the second power plus r to the third, on and on and on forever. All right, well, if r is greater than 0 but less than 1, this series converges to a finite number that is 1 over 1 minus r, where r is excess reserves. But since 1 minus excess reserves equals required reserves, we could simply just make it 1 over required reserves, or 1 over RR. So if we want to know how much money we actually create from a $50,000 deposit, what we do is we do 1 over the required reserve ratio times the initial deposit. Well, the required reserve ratio was 10%, so it's 1 over 0.1 times 50,000. Well, 1 over 0.1 is equal to 10, so we get 10 times 50,000. We have made $500,000. We've created $500,000 from an initial deposit of only $50,000. Now, if we were to increase the reserve requirement, right, say we wanted to double it, raise it to 20%, then we would not have created $500,000. We would be creating a lot less than that because banks have to hold on to more. They don't get as much that they can lend out. Therefore, the amount of money that gets created is going to be much less. So let's do an example of this to see how it works. So the deposit is still $50,000, but the reserve requirement is now 20% instead of 10%. So the bank, after they get their initial $50,000 deposit, can only lend out $40,000. So $40,000 just got created. After that, that $40,000 gets deposited somewhere. The bank can lend out $32,000. And this goes on and on like before, right? So we figure out the change in the money supply is equal to 1 over the required reserve ratio times $50,000, but the required reserve ratio is now 0.2. 1 over 0.2 is equal to 5, so 5 times $50,000 is $250,000 being created. So as we can see, if the Federal Reserve changes the reserve requirement, they can change the amount of money that gets created. If the reserve requirement decreases, more money gets created. If the reserve requirement increases, less money gets created. There are a lot of other ways the Federal Reserve can also change the money supply, like altering the federal funds rate via open market operations, which we'll be talking about in the next lecture. But this is one of the many tools that they have at their disposal in controlling and influencing the money supply. So to wrap up this lecture, we talked about what makes up the money supply in the United States. We talked about how fractional reserve banking works in the United States, and we talked about how money gets created via fractional reserve banking in the U.S. Next time, we're going to be talking about how monetary policy works in the U.S., namely open market operations. But until then, you are going to enjoy your weekend, and I am going to say peace out, and I will be talking to you in the next video.